You have to sort this problem out in your head, but this is where it starts, right? The toughest spot to negotiate is the space between your ears. And you have to figure out a way to see things differently and work on that. And that's part of headbanding. Remember, it's backwards courage. There's a lot of guys in this group that never thought they'd qualify that got qualified. You know, not all of them are posting their stuff. Some are quietly getting it done and they don't want any attention. They ask me not to repost because I know how you guys are. You bombard the shit out of them. The minute someone says, I just qualify for 200, you guys start hitting them up every 5 seconds. What'd you do? What'd you do? They did the same shit that I taught you. That's the truth. They just figured out how to make it work for them. And that's what I'm asking you to do. Find your spot. Okay? It could be a bounce trade. It could be a flip. It could be harmonics on the reversal. Everyone that is having success has made it their own. And that's the whole point. We've taught many different approaches, right? But how do you make it your own? How do you find your spot? Everyone feels different. Some people love the continuation. Some people like the AR zones, right? Some people like the flips. People are getting into it because the stops are tighter and you get an impulse out of there pretty quick, right? If you're an antsy, high-strung person, which I am 100%, you need almost like instant gratification. Okay, well, a lot of the younger guys are like that because that's what we get on our cell phones now, instant gratification. So the box trade provides that. If you're more of a waiting for something to set up, a harmonic trade might be for you. If you're more patient, it takes a while for those 4-hour patterns to develop. You might get 3 or 4 good ones a week. You might get one a week. You might get none. But if you're patient and you milk it for 100, 150 pips, then that makes up for 50 pips over 2-week period, right? 50 pips 1 week, 50 pips the next, or 100 pips on one trade. Same shit. Courage is backwards, and that's just the way it's going to be for the rest of your life, right? You do it, and then you have the courage to do it again. And that's what you have to figure out, is how to get your backwards courage, right? I've told you stories of me jumping out of buildings and going down rope and basically shitting my pants, I guess is the right word. Yeah, I was scared to death, man. I didn't know if that rope was going to hold me. But the more you do it, the more you become comfortable around the concept, and then it's you go up there and you don't freak out right before you step off the edge of a building 30 floors down. You know, it takes practice. It's the only way I can explain it. And to prove to yourself backwards courage. You take a demo account, you take it up 100%, 500%. Okay, then you do it with small real money, then you qualify. You understand? You have to get in a position, or you use the qualifying round as your guide, as your proof of concept. You prove to yourself that you can get past the test, and then you do it again with real money. And it should be like demo to you because it's their real money, right? I know it starts off as demo, and it's semantics, man. You're trading real money for a check, so it's not yours. You have zero risk other than the fee. That's an amazing, amazing concept. I would have killed for that 23 years ago. I had to borrow money out of my house. Talk about social pressure and pressure. You know, people thought I was sick. All right, courage is backwards, man. So I went through these problems last week, and I just summed them up for you. I don't want to get into them, but you got to work on this stuff, man. You got to figure out how to move forward, right? Okay, let's move through that. So I want to do a follow-up to the high-low drill. Somebody sent me in pretty good snapshot, but I want to talk about it a little more and figure out if it helps you guys. So the ultimate goal is to learn how to deal off of the areas of failed auction side, right? So a failed auction is when price comes in, it makes the low of the day, pulls back, and then down here somewhere it turns, right? And I drew it this way because it matches. So you would eventually figure out that this is the block zone, which would be the second leg. So the idea is to get the turn here, right? This turn, and start selling into this level, right? Or buying into this level, sorry. Buy into this level, hoping that you catch the turn right here. Okay, this person that I'm going to show you did a pretty great job for catching it, but this is exactly what I drew. You got this spinning top formation, right? This is a star pattern. Look, this and this, right? And this. This is a star pattern, and then a star pattern again. So if you have to understand how things are made up, right? So if you got this would all be on a different time frame. This would all four of these candles would be a 1 hour trade, right? So it goes into the low, it stops dead, spinning top, shift, spinning top, back down. Okay, so you basically have the same pattern. Goes down, short bar, goes up, short bar, drops. Okay, so when this bar starts to drop off of this closed formation, then the next one opens and turns red, you know that this is probably going to be the low swing. Could it be a continuation? Of course it can be, but the idea is you're in the US session, you had a drop, sideways print, flat, right? Sideways print. This is where it goes slow for the starting to change over. Then you're in the US session and it drops. Okay, we expect this to move somewhere in session. And it does just that. It goes sideways consolidation, breaks out lower, false move, session beginning, star formation, failed sell side auction, buyers take the book, long. And he got him pretty good. This is a pretty good setup because he had zero draw. Okay, he got stopped right there on one, but then he opened these up and they clean. He got profit. Not a bad run, but I'd like to see the action in here, right? Somewhere in here. And remember, this spinning top, you could draw. Look, talking about bookmap stuff. You could literally take these tops and make zones out of them. Just the top formation. Same up here. Steve, spinning top is a block zone. Yeah. What has to happen for that bar to get smashed on both sides? You got to have stripes pushing down on it, right? Or you got to have a capping order on both sides. It has to open here, push, and then cap it at the bottom quickly, right? Open here, hold the bottom, and cap the top quickly, right? Capping is when they just stop one bar. Usually it's a vector bar, but you get the message. Hold on. Okay, so the idea is you can use these as zones and you see how it works out, right? It finally breaks and comes back. This is where it finds resistance and then pops through. Eventually, I'd like to see you get in on these where the book actually flips, right? But for the high-low drill purpose, you might become really great at grabbing these and it might be enough for you. All right, but this is a pretty good shot at it. But the idea is I talked about this, is trade, no trade, right? So you take this and cut it right down the middle, just like this part of the chart. Okay, this is no trade, no, and this is go. And that's it. No trade, go trade. So when you get this formation, you literally can cut the W in half. We're looking for this. We get this. But this is, you don't want to be dealing in here because they can come back and hit your stops. Unless you get, there's three different types of formations. One's higher, one's lower, one's even. So you need to see, you don't know what's going to happen when you're taking this. So the idea is when you see this close, maybe you start dealing in here. You try to catch it. If you do the drill enough, I promise you it's going to change the game for you. Promise you. So that's what you need to do. All right, I hope this makes sense. Cut the W's in half. Go back when you do your homework. Cut the W's in half and see what the formations look like. Just literally block out everything in your mind and look at this formation right here, these collection of bars. Okay, you have some other things working against you, right? You have angle and separation into the lows, but this structural component, right? Vector bar, one bar to the outside, link these three bars together for a 1 hour chart, whatever it takes. Vector to the outside, you have a star formation, spinning top, drop, another top, and then it doesn't hit that zone again, right? So again, for a mini zone, take this bar, right? And you could take the body of the bar and get a zone out of it. This would be the low swing. Just go through this collection of candles and start seeing how it's the same shit. It's a straight drop, right? Vertical markets are coming to an end. Slow and steady, vertical. Slow and steady, vertical, right? This sideways print, shift, regular run, right? We know from box to box, this was the whole session, right? This was a slow, steady, methodical drop. Dealers were booking profits, man, all the way down, accumulating and booking. And then they got to hit the stops, create a vector, right? What do people think on this? They take this and go, oh, continuation. How many people got jammed right there? Not understanding the nuances, end of the day, change in sessions, reversal, right? You know how it goes. It goes drop, drop, pop, right? Or pop, 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 drop, right? Up, up, drop. It's 3 sessions. They rarely move all 3 in the same direction because they accumulate over 2 and then go the reverse. Accumulate over 2 sessions and go the reverse. And they might end here. Then if it closes below the 50 and below the 1/3 of the ADR, that becomes, right? ADR would be 100. And if they close 33 pips or lower off of the ADR, then that's a weak close. If it's down, if it's up to the top side, it's a strong close. That means that they're basically holding below the level. Then you got to look for stop hunt high at the session open drop. It's little nuances that just takes time. How many of you knew that stuff was going to pop? After these big drop, Euro making it to parity. Okay, I haven't seen that shit since I told you the joke. No one used to use a stop when Euro was worth less than $1 in 1999, and it just popped one day and it never looked back. Now here it is again, all the way back to parity. I already told you, they shift the zones 3 months, 6 months, on the quarter, on the semi-annual, end of the year, coming out of the first of the year. There's always aggressive moves. This is nothing new. Blame it on war, inflation, higher interest rates. What does it matter? As long as you can afford a loaf of bread and put food on your table, it's irrelevant what's happening in the Eurozone unless you live there. It's irrelevant what's happening in the US unless you live here. That's what you have to figure out. Do you have enough money to combat inflation? Do you have enough money? Is your interest rates on your mortgage or whatever you have, your car loans, is that enough for you to afford? If not, you got to figure this stuff out. All right. Okay, so I want to get right into charting. I had one more Bookmap chart, then I'm going to review some people's homework. We'll see where we're at. I'm going to try to keep it to around 45 minutes on these sessions. My goal is to not bore you, but get to the point and get out. I don't want to keep you at summer, and I could talk about this stuff 4 hours straight, man. Just basically have a sore throat. I want you guys to get it, but I don't want to give too much in one sitting. Okay, so this was the last chart I wanted to talk about. This is a pretty good formation. Crystal clear, right? It comes in. Let's look at this together. Look, there's your hook back. There's your hook back. There's your hook back. Okay, it's the last place. Vectors into the low, pulls back, hits it, pulls back, creates the apex, and then hits the low by 1 or 2 ticks, right? So here's your liquidity block, blocking the level, right? Okay, now look at this big suspect orange print down here. Okay, this is dealer insurance, right? This makes sure nobody's getting through. So it's usually 10 ticks away. So we go 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 ticks. So between 8 and 11, you're blocked. The dealers are insured. Okay, so now they throw this in here. They get these orders into here absorbed, right? Why do sell bubbles appear at the lows and price doesn't drop any lower? because buyers have their stops triggered. It's the opposite. If you buy a contract and it hits, it has to be sold to exit, right? Buyers, it's BS, right? Buyers become sellers, sellers become buyers, opposite side. If you're short, I should have drew it this way, right? If you're short, buyers. If you're selling, you have to buy to exit. If you're buying, you have to sell to exit. If you're going up, you got to take the opposite. Just understand how important that is, right? Because then you have all these little stop runs. It's endless. This stuff is in here day in and day out. So you can come back here looking for your apex nadir, right? You would come over here and you literally can draw this out into time. There's your swing. Okay, what do you need to change the structure of this market? You're in consolidation. What do you need to flip? You got to break the level. Got to break the previous levels, right? Hit the stops right here by a tick or two. There's your bleed. There's your absorption, right? And whoever got in here, right? Look, this looks like it. But what happened is they absorbed those. This ate into this, stop levels, right? And they triggered whoever got in early. They triggered them here. And then they probably sat there and didn't get in and wish they would have. And then it came back. And then they got stopped out again. If they chased it here, right? If they go, oh man, there it goes, and they chased it here, they got taken out by a tick or two, right? I didn't realize there's a little bleed right there. Okay, so that was enough to open the spread and take them out. I can't draw this stuff enough. Pile on, stopped out. Pile on, stopped out. Get in, some sell orders, get in, gone. Okay, so you have an opportunity above the zone to enter here, or you have an opportunity here. When it breaks up, you refine your entry off of this. Right? This would be your 1 and your 2. It prints weird. It's not like a candle, man, but you have to understand what you're looking at. You're looking at the order flow bubbles and they're different sizes. Then all of a sudden you get takes off. Why? Okay, well, you got liquidity trapped here. Right? There's orders on the book. Notice how it skipped through there and bought them on the other side. They had to get through that. They pushed it. They pushed it by putting these orders in place, and it draws price up. Then they pulled back, tapped back into it. Right? If I boxed up, it's 3. We're talking about 3 ticks. If I box this up where the liquidity was, it broke through and hooked back. And then notice how it starts graying out as it goes through, and then it turns completely black after they absorb it. It's gone. Orders are gone out of the book. Right? Absorbed it. Book is black. Shoots right through there till the next bubble. Notice how when they hit, they're gone. The orders, the book is black. See it? Look at all this liquidity. It's black on that side. The orders are lifted, absorbed, or pulled. Okay? Lifting means, I'm not sure if I explained this correctly. Lifting means they go, the order, like it's black here, and then it appears at the next level higher. Right? There's no lifting here. It's gone. It's just pulled. And then maybe you get, let's see, I'm trying to see another example of lifting. It's like this, okay, this had some color, then it was lower, and then it's blank, and then they put it back. They pull and put orders in place, and they absorb them. There's just no other way to explain it. It's a combination of the size in the book, the bubbles absorbed that are doing the absorption, the Pac-Man, stop runs, all that stuff has to be included in that. But you're looking at pattern. Listen, I've been trading these patterns for 20 plus years. You don't need this friggin' book. But the idea is that if you understand what you're looking at from where the pins are formed on these swings, right, and how these little V's and A patterns, right, A-frame, V-frames, that's the whole business, is consolidation, breakout A-frame, breakout A-frame, breakout A-frame, breakout A-frame. That's the whole business. And it's no different on the sell side. Consolidation, push down, V-frame, V-frame, V-frame into the lows. That's it. You could sell every one of these. You can take a position here, one, add to it here, get out at the sideways print, and on aggregate, you have a hell of a good run, right? Never use the same amount of lots. Use a 3, 2, 1 in your lots, just like you're counting down, so that if 3 and 2, you have the stop and 1 comes back and hits it, that 5 lots is going to cancel out 1 lot, any loss that's there. If it's 10 pips, you'll be minus 10, right? And if this was 20 and this was 10, then you got 30 pips with 3 lots, right? 20 pips with 2 lots, and minus 10 with 1 lot. Do the math. It's a good day. There's different ways to go about it. Same thing, right? You're looking at this, get the break, go long 30, right? These trades degrade. There's degradation in trading, right? You have time expiration. As time moves forward from this formation and price moves away, the trade starts to degrade. So you need to get heavy early and lighter as it moves away. Because why? The longer price goes up and turns vertical, it's more likely to come back to some support or resistance level you can't see that's hidden in the book. You can't see that. So how do I know that price is not going to come back to here in an hour and a half, and I'm sitting here trying to milk 1 lot for everything I can get out of it, and I end up giving half of it back by waiting? Right? This is why this degradation is the biggest reason why people lose early and they stay, and it gets worse and worse and worse. And this is a big deal. I want you to understand. Then what happens? You blow your account, pissed off, you come back the next day and there's 5 perfect setups. That's the way it works. But if you get pissed off, and you should have a max draw of 3 trades a day, right? Or some number amount. If you take your 3 stabs at it and you're wrong, shut it down and go to bed. And if you're not going to bed, go to the gym or do something else. Go burn off that for guys, that extra testosterone, that rage. Women, take it out on your husband. That's the funnest way to do it anyway. So listen, I know that's so not politically correct, but I'm kidding, all right? So listen, here's the deal. Price moves into the lows, sideways prints, and breaks. You need to get in here, or find your straightaway continuation type trade, or you can deal off these lows. But if this is your first trade and you're right, then you need to take second and third flip, or first and second flip as your third trade, and that's it. Get out in front, leave it alone. Okay, let's say you got in here and blew this, and then you see it going your way. Then you turn to buyer, and you realize here, after all this crap, I want to buy here. I'm pretty sure this retraced back here, by the way, because you got 1, 2, 3 higher and then pull back. So if you chased it, right, what happens? The 1 hour time frame comes back to retest the apex nadir. Can't tell how many times you get a 5-minute flip and then it comes back on the 1 hour and flips. So you're 3 hours in, and then you're getting long up here because you're chasing shit, and then they do a huge retrace on you and you're going the wrong way and you get hit your stops. Then you go, I'll show them, I'll lift my stop. Well, you show them all right. Show the man to hand your money to him. Got to have a loss limit, man. And that's a temperament thing. You got to get through it. It's perceived risk versus real risk. What did you lose? 2%, 1%, 5%? Okay, that's your max draw for the day. Stop. Come back tomorrow early in the cycle before the stuff is degraded. I can't say that enough how important it is. Degradation in trading. All right, I'm going to look at this chart and probably wrap it up tonight. So this was one of our students. It's up to him if he wants to make his name known. I never give out names, never try to embarrass anybody, but this is pretty good stuff tonight. So he's still ironing out the nuances. It's coming together. A few things he's noticed that he's doing wrong. Okay, this is perfect timing right after last week's session. Don't get too caught up in the 1 minute. I couldn't agree more. A little anchor and what looks like blocking seems to often come back for a second leg on the 5 minute. Yes, I prefer by the way, I prefer the 5 minute to the 1 minute. Sometimes if you're looking for a little micro pattern, you want to get a really tight entry inside that range, I'll look at that. But the biggest thing I can tell you is I don't look at the 1 minute and 5 minute chart till I'm looking to enter. The work comes from the 15 and the 1 hour. I don't know how many different ways you want me to say that shit. Okay, so he decided now he's going to wait for a second leg on the 5 minute chart. I think this is brilliant. Okay, putting my stop too tight. I just talked about this, so it couldn't be any more timely. If there are a few potential pullback zones within a few pips of each other, I should aggregate into the trade and have the stop above the whole zone. Yes, still respecting the overall risk. Of course, you control your risk. Okay, if you're, a lot of you guys are qualified for the bigger numbers of 200,000, I think that puts you at a 50 lot trader. Okay, you're not going to get filled all the time on the bar. But if you have this kind of bar and you build your zone, let's say, I don't know, I didn't draw right. Let's say the wick is like this and your zone's going to look like this. This would be 0, your entry, down to 10 pips. Okay, so 50 lots, go 20. Maybe you can go 10, 20, 40. What would it be? No, 10, 20, 20. Or you can go 20, 30, right? That's 50. Some way like that where it's spread out and stop below that. And then just figure out the calculations. The way you do the calculations for that is this. You take your zone, your 0 entry trade is going to be 20 lots, and then down here is 30 lots. Stop is going to be some number, 5 pips. Okay, so what's 20? If this is a 10 pip box, that's 20 stopped out at 25 pips, maybe plus 1 on the spread. 30 stopped out at 5 pips, right? 30 at 5 pips. That's what you have to figure out, what that cost you in dollars. When you figure out what this cost you in dollars, plug that into your spreadsheet. If it's a 1 to 3% max, then you're in the right spot for your account. And the spreadsheet will help you with that. Spreadsheet's going to tell you the exact lots at the risk, and then you figure out how to divide it up on the stop size. Okay, and if you want to do it a different way, you can go, if you want to break it into 3, you can go 10, 10 would be 20, and then 30. Or you can go 10s all the way down, spaced out over the bar. The problem with this is, I'm going to tell you, a lot of times you're going to get really good at making your entry, and you're only going to pick up 10 lots, and you're going to leave your big chunk sitting here. But then the risk becomes real, right? When you take a stop, you eat the whole thing, but when you're right on a aggregate, you could get a partial fill, partially right, which means this win will not offset that loss, or it'll be a scratch or a little less than a scratch on the next trade. That's what you got to be concerned about when you're doing that. I'm 100% for aggregating, especially in futures. Pound dollar or 6B doesn't have as much liquidity early on in the day as it does like late London going in the US, and Euro is the highest traded futures contract, 6E. So just got to figure out the nuances that work for you, and that comes from demo. That's what demo's for, man. Demo is not going to give you sea legs. Demo is going to make you feel like a what is it? A demo millionaire. You got to convert that shit to real as soon as possible. The longer you spend on demo, the harder it's going to be for you to transition. That's a fact. All right, you need to put some kind of squeeze on yourself to get out of demo. Hope that makes sense. All right, let's look at this guy's chart. I think I'm going to wrap it up here. Okay, so he's got a sell side bias, right? He has his 1 hour chart. I want you to notice he's got his 1 hour chart overlaid on his 15-minute chart. Perfect stuff. His bias was short coming into possible reset and high volume area on the 1 hour chart. Also in level 2 long, so we can trade both ways. Yes, we expect a retracement back on level 2 or a straightaway higher. So he got his vector, right? Look, here's the session boxes. He got a vector high, top, failed auction. Entered in here, he took a stop on that. And then he got the pullback, retrace into the box. And he got his order on. And he went profit on both of those. And this whole run went for 75 pips. Okay, he caught the pullback, but should have held for the measured move at or at least near the water, right? So look, measured move, I've talked about this. This measured move stuff's legit, man. The market moves the ADR in measured type moves. Look at all these legs. This and this is equal to this and this, and I guarantee if you drug an arrow over here, this shit equaled that. So you got 1, 2, 3 impulse legs, all about the same ticks. So that would make up, right? If they're 35 pips a piece or 30 pips a piece, that would make up 100 ADR. If it's a bigger instrument and there's 60, then the ADR would be 120 on that, right? It's a really good way to figure out the target. And you could take your fib tool, right? Fib extension, and look for 100% extension. Hit here, you tap here, and then you tap here, and it puts out the target out in the future for you. And then if you look to the left, over here, you got this consolidation, which is probably a point of control from a previous move, right? So you can guess that it's going to bounce off of there. You start looking at these sideways points of control, and you get action around them. Right, this didn't quite come back to it, but you'll get action in them. Previous points of control, right? Points of control, consolidation where the market appeared to move, but it was sideways. Get bounces off of these. You could draw zones on these and project them out, man. Simple to do, not hard work, not rocket science, right? Take these, stretch them out into the future. The low swing, we know that already. Previous low of the day, we trace that with a blue marker, right? Why? Because the daily candle prints here and here, the high and low of the daily candle. But all these beautiful bars for us in the middle on a day chart is just this, right? That's all that shit looks like on a daily. So how do you find your way inside here, right? You find the consolidation, which is the opening price on the daily bar. You find your high M, and then your 3 pushes into the low and a little extension and back and the day. That's how a daily candle is formed. If you don't realize that and you just realize it now, congratulations. That's how it works. Okay, makes sense. By the way, I just realized it says 75 pips, so it's probably 75 by 3. GJ, so you're looking at 150 pips maybe available. He had 75, 75, and 75 available. So if he didn't take the first leg and he took 1 and 2, he had an opportunity to put 150 pips. That's max possibility, right? Let's just say he did 50 twice. It's 100 pips in a day without sitting through this crap, because you know how the market's structured now. You know better. All right, I'm going to end it here. I'll see you guys next week. Hope you enjoyed the session, and I'll continue along with this dialogue in line next week. Have a great night. Thanks.